Deep in the background of our economy, the central bank is kind of like the operating system on your computer. And South Africa's central bank just did a massive system update. Basically, they threw out a framework from 1998 and installed something totally new built for today's financial world. So we're going to break down what exactly they changed and, more importantly, why it matters a whole lot more than you might think.
So it really all boils down to this one question. What happens when the main tool you're using to control interest rates, the actual price of money, starts to, well, break? When it gets less effective and super expensive to use? You don't just put a Band-Aid on it, you have to build a whole new system from the ground up. And this right here, this really gets to the heart of the whole change. For more than 20 years, the central bank's job was to basically create a shortage of money in the banking system. Think about that. They had to make cash scarce on purpose to control its price. Now, the strategy has done a complete 180. The new job is all about managing a permanent surplus of cash. Let's dig into what that actually means. Okay, so before we can really appreciate the new system, we've got to look at why the old one was, well, on its last legs. The cracks had been showing for a while, but things really started to come to a head recently. So here's the old playbook, right? The South African Reserve Bank, or SARB, would intentionally make sure there wasn't quite enough of that electronic money, what we call bank reserves, for all the banks. This basically forced any banks that were running a bit short to go to the SARB, cap in hand, and borrow from them. And the interest rate the SARB charged for those loans, that became the main policy rate, the one that sets the tone for pretty much every other interest rate in the economy.
So what was the big problem? Well, the whole system just got flooded with cash. And this chart really shows you the scale of it. For years, there was already a bit of a surplus, but after 2020, boom, it just exploded. Trying to create an artificial shortage when you're dealing with a massive surplus like this, it's kind of like trying to drain an Olympic-sized swimming pool with a teaspoon. It's just not going to work, and it's incredibly inefficient.
And this wasn't just one single leak causing the flood. Nope, it was a bunch of things all happening at the same time. For years, the SARB had been building up its foreign currency reserves, and every time it does that, it pumps more money into the local system. Then, the COVID-19 pandemic hit. That led to the central bank buying bonds and the government spending more, which just poured even more cash into the economy. The old tools, they just weren't built for this. So, the SARB was at a crossroads. They could either keep fighting this uphill battle against a growing mountain of cash, or they could pivot and design a totally new framework that actually uses that surplus to its advantage. And, well, they chose to pivot. You can really think of it as two totally different philosophies. In one corner, you have the old way, carefully controlling the amount of money in the system. It's like building a narrow corridor to keep the interest rate from wandering too high or too low. In the other corner, you have the new way. Just flood the system with plenty of cash, and then build a floor underneath the interest rate so it can't fall too far. It's a completely different way of looking at the problem. So how does this floor system actually work in practice? It's actually pretty clever and surprisingly simple. The central bank makes sure there's more than enough cash for everyone. Then it goes to the commercial banks and says, hey, any extra cash you have lying around, you can deposit it with us and we'll pay you interest at our main policy rate. Now here's the genius part. No bank is ever going to lend money to another bank for less than what it can get completely risk-free from the central bank, right? And just like that, you've created a solid floor that the interest rate won't drop below. But here's where it gets really interesting. South Africa didn't just grab a standard floor system off the shelf. Nope. They went with something more advanced, a more modern version called a tiered floor. And this is the really smart part of the whole redesign. A tiered floor is basically a hybrid model. It takes the best part of a floor system, which is having plenty of cash around for stability, but then it adds a key feature from the old shortage system. And the whole point of that feature is to make sure banks keep lending to each other, keeping that market alive and well. Those special limits, they're called tiers or quotas. So if you break it down, the new framework is basically a three-step recipe. Step 1, make sure there's plenty of cash in the system for everyone. Step 2, create that floor by offering a deposit account that pays the main policy rate. And then, the secret ingredient, step 3, add quotas that limit how much each bank can deposit at that top rate. That's what gets them trading. Now, these quotas, they're really the most innovative piece of this whole puzzle. So let's zoom in a little and see exactly how they work.
Okay, so what are these things exactly? I mean, if there's tons of cash and the central bank is paying a good rate, what stops every bank from just parking all their money there and forgetting about lending to each other? A quota is really just a limit. It's a cap on the maximum amount of money a bank can stick in its deposit account at the SARB and get that full top interest rate. Now, if a bank has more cash than its quota, it can still deposit it, but it's going to get a much lower, less attractive rate. And that creates a really powerful incentive for that bank to find a better use for that extra cash, like, say, lending it to another bank. And these quotas aren't just pulled out of a hat. There's a whole system to it. They're calculated based on a bank's size, its share of the total market. They get updated every 6 months so they stay relevant. And there's even a 10 billion rand shock buffer built into the total to handle any unexpected swings in the money supply. Oh, and here's a neat detail. The rules are actually designed to give smaller banks proportionally bigger quotas, which helps make their lives a little easier. And this slide gives you a great idea of what that looks like in practice. You can see how a really big bank might get a quota of, say, 15 billion rand, while a medium-sized bank gets maybe 1.5 billion, and a small bank gets a couple hundred million. So it's not a one-size-fits-all approach. It's tailored to the actual structure of the banking system. So here's the big takeaway. The whole point of these quotas. They gently nudge banks that are swimming in cash to lend it to banks that still have some room left in their quotas. This keeps that crucial interbank market buzzing. And, maybe most importantly, it prevents something economists call the ratchet effect. That's a situation where the central bank's balance sheet just gets bigger and bigger and bigger over time. It's a really smart piece of financial engineering. Okay, I know this has all been pretty technical. We've been deep in the weeds of financial plumbing. But what does it all mean for the real world? Why should you actually care about any of this? Well, the benefits are actually pretty huge. First off, the new system is just more durable, more robust. It's much better at handling financial shocks. It also gives the central bank way more flexibility to jump in and provide emergency cash during a crisis without completely derailing its normal day-to-day policy. And believe it or not, it's actually more efficient and simpler for everyone to operate, both the central bank and the commercial banks. And this is a really important point, straight from the SARB itself. This is a technical change. It's an upgrade to the how, not the what. The main goals of monetary policy, like the country's inflation target, those haven't changed one bit. Think of it this way. They've just upgraded the car's engine, but the destination on the GPS is exactly the same. So, South Africa's central bank has rebooted its core operating system to deal with a new reality of abundant money. And it really leaves you with a final big question. As our entire financial world gets more and more complex, what other foundational rules and assumptions, the ones we've taken for granted for decades, might be next in line for complete rewrite?